If you are an option seller looking to generate premium for income and you have no intention of being assigned the underlying stock, then the number one thing you need to learn the skill of is not only selecting the right strike prices, but something that's more important than that is being able to roll an option. This skill over the last 2, 3 years is taking me a while to kind of master of not only when to roll, what expiration to pick, what strike to pick, because there's been a number of trades that I've been involved in where I've ended up taking assignment, and sometimes you will have to take assignment, and that could be down to early assignment or the price drops really quickly by a lot where it's very difficult. And frequency therapeutics, one where I was, trading, had no intention of owning the underlying. It missed its FDA approval. It absolutely tanked by 50, 60%. I had no other option but to be assigned the shares. And ultimately, I sold that position for tax loss harvesting purposes. But generally, when you do this, you need to be able to learn how to roll an option, especially in the money. Now, the rule of thought is when you're rolling an in the money option, and what we mean by an in the money option, let's just say in this example for Coinbase, is I have selected the $75 strike. The price of Coinbase is currently 71.43. So I'm currently in the money, and we have an expiration of August the 26th. Now, what this basically means is by August the 26th, so this Friday, I'm shooting this on the 23rd, if Coinbase stays below $75, I will either be assigned 100 shares or my broker will margin call me if I don't have the collateral to take assignment of 100 shares. So that's not a good place to be in. So what we need to understand is how to roll this option. And what I've done is I've purchased this option. I've got no intention of owning Coinbase at $75. I do like it at these levels around the 40 odd mark, but at $75, I have no intention of being assigned these shares. So what we're going to do over the next few videos is I'm going to show you guys live, and I'll show you, take screenshots of all the trades and everything of how I roll this position. Not only how I roll it, but what strike do I roll it to, and how much money I'm making while rolling. Because this strategy, whether you're selling puts or selling calls, it is a bullish strategy. So at the end of the day, if the price is going up and your strike is never pierced by price, you will always make money. But as price starts to go down and so it takes a gap down on some news or something on those lines and you end up in the money, this is where option traders panic. And again, this is a skill, right? This is a skill to learn how to roll a trade. And again, I want to teach you guys how to do this. So the school of thought that most people teach when it comes to it, and it is correct in terms of the theory, but doing it in practice is a bit harder than what it is I've got puts and calls here. What we're actually going to do, we're actually just going to concentrate on puts because I don't actually own any shares. And if you guys are interested in seeing a call version of this, then just comment down below and we can have a look at that as well. So when you sell puts and you are currently in the money, there are two things you want to do. When it comes to rolling, which basically means you're buying back the option that you sold, more than likely you're going to buy it back in a debit. So therefore, let's say, I can't remember how much I sold this for. I need to go back and have a look. But let's say I sold it for $50, right? Now we're in the money. This option's probably worth, 80, 90, $100. So it's, I'm down 100% of my money if I just bought back this option. So what we do mean by rolling is a two-phase approach, which happens at the same time by your broker. You buy back the option that you sold, more than likely for a debit, and then you sell to open a new position, hopefully for a net credit. And the way you roll your position is you want to roll your position down in strike. So your new sell to open is going to be lower than $75. It may not necessarily be lower than the current price. That would be great if it was, but as long as you're lower than your option price that you currently set, you're going in the right direction for then. So let's just say price continues to do this, and then let's say you open a 65 call. Eventually, price only has to travel up to here as opposed to travel up to here for you to get out of this trade. So what we want to do is we want to roll down in strike from 70 to 74, 70. It doesn't matter what that number is. The bigger the number, the better. But this will all depend on the second element of and rolling out in time. So picking an expiration date that, in my opinion, is close enough to get you a net credit. So what I always look for is, and this is the golden nugget piece, is I'm looking to roll down as many strikes as I possibly can by rolling out for as little of time as possible for a net credit. And it's probably not the right way to do that, but you get my point. To roll out for a net credit. So what is a net credit? A net credit is as I mentioned before, when you buy this back, you'll probably buy this back as a debit. Let's say it cost you $100 to go buy this option back. And then when you open your new sell to open, let's say you opened the $70 strike, expiring 2 weeks from now, and you are able to get $120 credit for that. So the difference between both trades, the 120 that you're going to receive in, minus the 100 it cost you to buy back your original one, you received a net credit of $20. So that is the key of this game. So, and I'll say it again, you want to roll down in strike as far as you can. You want to roll out in time as minimum as possible, whether that's 1 week, 2 weeks, 3 weeks, whatever it may be, for you to achieve a net credit. Now, there will be times where you have to roll out by a month to receive a net credit. Or what you can do, you can roll up by 2 weeks and take a small debit, as in actually pay money to roll this strike down. Hopefully, I'll get into that position because I want to show you guys how to manage this kind of position. So, what we're going to do over the next few days, I don't know if I'll do it daily or not. Probably will have to just do well when I get near enough to expiration. I'll show you when I do the roll. I'll record it and show you guys. But effectively, what I've done is I have a $75 in the money option. Now, tomorrow Coinbase could go up. It's up pre-market slightly at 72, 73, which is what I want it to do. I want it to stay above before expiration. So what we're trying to do here is show you guys an example of how I would manage this trade. Now, I don't normally buy in the money options. Yes, you can generate more premium and various other things. I don't recommend it. I always recommend selling below the current market price. But for this example, I did buy it in the money. I bought it at the money around the $75 mark, and you can see here it's tanked even more since doing that. So we will go into the numbers, and then I will show you the buyback and the sell to open. Hopefully rolling down in strike, out in time, because Coinbase could drop tomorrow to 50. I could have a problem here, but again, we will manage that situation, and I'll walk you through what I would normally do in this situation. So I really hope you've enjoyed this, and this an overview of the number one thing you need to learn. I'm going to show you it step by step, so make sure you subscribe, like this video, comment if you've got any questions on rolling an option down, and I'll put this in a playlist which I'll link to. If once I've got the future videos on, there will be a playlist here that will walk you through the next episode of rolling down an option. I'll probably call it a mini series or something. So hope you've enjoyed it. Like, subscribe, and I shall see you guys in the next video.